Most traders lose money not because they're wrong, but because they cannot sit still for 90 seconds. 90 seconds. Just a minute and a half is enough for the brain's chemical storm to hijack judgment, override logic, and make you click buy or sell without real reason. That is all it takes for fear, dopamine, and impulse to create the illusion of opportunity. Amateurs see a flashing green candle and feel they must act. Professionals see the same candle, but they feel nothing at least, nothing that forces action. They understand that the first instinct is almost never the correct one. Every overtrader, from the small retail account to the ambitious day trader convinced they have a secret edge, shares one unmistakable symptom, an emotional itch masquerading as opportunity. They don't trade the market, they trade their own need for control, and the market patiently punishes them for it. The truth is brutal. The difference between consistent traders and consistent losers is not information. It's control over the seconds immediately after an impulse hits. That window, often overlooked, is where fortune is quietly made or casually destroyed. Most amateurs believe trading is a constant game of action, that the more they click, the more they win. They accumulate charts, indicators, and scanners as if volume alone could produce wisdom. The professional knows a completely different truth. Profits are made as often from resisting impulses as from taking trades. Every trade avoided is potential loss prevented, and the math on this is cruelly precise. If you lose 2% on a trade you shouldn't have taken, it might feel trivial. Take 5 impulsive trades in a row and watch a small account disappear. The professional mindset treats these 90 seconds as a firewall. They know that sitting tight for this fraction of time can neutralize emotional triggers and let reality, rather than hormones, dictate decisions. Jesse Livermore, the legendary trader, captured this elegantly when he said, "It was never my thinking that made the big money, it was always my sitting." He understood, at a fundamental level, that the hardest part of trading was not analysis, chart reading, or finding setups. It was the discipline to wait while the tape tested patience, while impulses demanded action, while every neuron screamed for relief through a click or a trade. That sitting, that controlled inaction, separated the survivors from the casualties. To understand why 90 seconds matters, you need to recognize the chemical mechanics of your brain. When a setup triggers your attention, a breakout, a sharp loss, a sudden price spike, your body reacts first. Adrenaline floods the system, cortisol spikes, dopamine whispers that opportunity is fleeting and urges immediate action. This reaction is automatic, primal, and unconscious. If you respond, your trade is no longer a calculation, it is an emotional reflex. The amateur believes action itself is proof of competency. The professional knows this is the moment when mistakes are most likely to occur. These first 90 seconds are a battlefield. Every impulsive trade is a surrender. The secret, almost invisible, is that sitting still is the most aggressive move a trader can make. Doing nothing is not passivity. It is preemptive defense, the only antidote to the chemical hijack that lurks within every trading decision. Consider a scenario. A trader named Sarah sees a sudden breakout on her favorite tech stock. Her heart rate increases. She feels the itch to click immediately. She reasons, "It's moving fast. I can't miss this." But if she applies the 90-second pause, she discovers layers she otherwise would have ignored. The breakout might be a fake-out. Volume may not confirm strength. The risk-to-reward ratio could be poor. By simply waiting, by allowing her brain chemistry to settle, Sarah moves from reactive to deliberate. When she finally evaluates, she either enters with a clear rationale or walks away with money preserved. That's the essence of the 90-second rule. Pause first, trade second, or not at all. Every decision made under impulse is a tax on the account. Every decision made after the pause is potential profit. The professional understands this. They don't seek adrenaline, they seek clarity. They treat emotion as a warning light, not a green arrow. Sitting through the initial chemical storm has another hidden benefit. It allows patterns to reveal themselves more clearly. Short-term setups can appear convincing in the heat of the moment, but often dissolve under scrutiny. A price spike may look like momentum, but could be a liquidity trap. A support level may seem pivotal, but is actually a minor fluctuation. By holding for 90 seconds, traders force the market to show its intentions. The amateur jumps, hoping intuition will carry them. The professional waits, and in waiting, turns uncertainty into a measurable probability. Livermore himself described the market as a machine for testing patience. His fortune came not from being first to act, but from being last to react to emotion. Every single trade had to pass through a filter, one that checked the impulses generated by the trader's own body, not just the chart patterns. That filter, invisible to amateurs, is what the 90-second rule institutionalizes. Of course, 90 seconds is not just biological, it is psychological training. When a trader repeatedly enforces this pause, the mind learns to tolerate discomfort. The urge to act diminishes. Emotional reactions are not eradicated but recognized and managed. The professional develops what might be called a calm reflex. Impulse is acknowledged but not obeyed. Over time, this creates a compounding effect. The more you wait, the more evidence you accumulate, the more disciplined your entries, and the fewer mistakes you make. Small accounts are preserved. Medium accounts grow steadily. Large accounts survive storms that would wipe out amateurs. The math is undeniable. A single impulsive trade costing 2% might seem trivial, but the compound impact over weeks, months, and years is devastating. Each 90-second pause becomes an investment in structural advantage, a hedge against emotional bankruptcy. Let's return to the contrast between amateurs and professionals. The amateur sees opportunity in movement and feels compelled to capture it immediately. The professional sees movement and feels compelled to wait for confirmation, to verify reality over emotion. They do not seek to be busy. They seek to be correct. Amateurs equate action with skill. Professionals equate patience with mastery. Every impulse they resist strengthens the edge. Every forced trade they avoid compounds their resilience. Livermore's genius was not in predicting tops and bottoms with absolute certainty. It was in building a system where impulse had no room to interfere, where the tape dictated the outcome, not the trader's desires. That's the hidden architecture of the 90-second rule. It externalizes discipline and transforms waiting into a measurable strategic advantage. By now, the logic should be clear. The 90-second pause is deceptively simple. It doesn't involve complex indicators, multi-time frame analysis, or fancy pattern recognition. It involves one act: stop, count to 90, breathe, observe, evaluate. During this time, the amateur's mind screams for action, the charts beckon, and every physiological cue pushes for impulsive entry. The professional acknowledges these signals without acting, allowing reason to reassert control. After 90 seconds, if the trade still meets criteria under calm evaluation, the click is deliberate, informed, and risk-controlled. If not, it is ignored, and capital is preserved. Over time, the result is profound. It's not just about avoiding losses, it's about creating the internal conditions for consistent performance. In practice, traders can implement this immediately. Start by observing your own reaction to triggers. The next time a market moves fast or a potential trade appears, consciously delay action. Count to 90. Focus on breathing. Ask yourself, am I trading a signal or am I trading emotion? Notice how often your impulse fades before you act. This is the mental margin between profit and loss, between survival and destruction. Amateurs rarely see it because they believe speed equals skill. Professionals cultivate it because patience equals power. Each 90-second pause is a tiny training session in mastery, a micro decision that, when aggregated, defines long-term success. The 90-second rule is more than a tactical pause, it is a philosophy of trading. It reframes the very definition of edge from prediction to composure, from quantity of trades to quality of decision-making, from chasing opportunity to respecting the market's own timing. Every trader faces moments of temptation where charts, signals, and emotions conspire to make impulsive action feel necessary. The rule is simple: wait, observe, confirm, decide, repeat. Doing nothing, paradoxically, becomes the most potent action. The first 90 seconds of every market trigger are when losers act and winners wait. It is when accounts are destroyed or protected. It is the window that separates amateurs from professionals, chaos from clarity, impulsivity from discipline. As Livermore understood, the most profitable trade is often the one you do not take. Sitting, observing, and waiting is the silent architect of success. In the next chapter, we will explore exactly why these 90 seconds are your entire edge, why this small window is where markets reveal truth, where emotions die down, and where deliberate opportunity emerges. We will break down the mechanics, the psychology, and the protocol that turns waiting into a weapon, allowing you to transform reactive impulses into controlled, disciplined trading decisions. The first 90 seconds after any market trigger are not trivial. They are decisive, and mastering this pause is the single most effective step in stopping overtrading before it starts. Every trade triggers more than numbers on a screen. It triggers a chemical reaction in your body. When you lose, cortisol surges, signaling stress and danger. When you win, dopamine floods your system, creating a euphoric illusion of control. Both reactions push the same dangerous narrative: you must act again. This is the unseen mechanism behind overtrading. On your statement, it looks like chaos, a series of illogical moves that accumulate into losses. In the moment, it feels rational. You tell yourself, I'm just recovering my edge, or I can catch the next move. But the truth is harsher. You are chasing chemical closure, a temporary satisfaction created by your own neurobiology rather than by market opportunity. The market itself is indifferent to your internal chemistry. The problem isn't charts, indicators, or setups. It is the biological imperative to react. Overtrading is not a failure of intellect. It is a failure to control instinctive responses that have evolved to protect, not profit, you. This is the hidden battlefield where amateurs are defeated long before the tape even tests their analysis. Consider the story of Daniel, a trader with 3 years of experience and a modest account. Daniel takes a small loss in the morning on a trade that initially seemed promising. Instead of pausing, reflecting, or reviewing his risk, he immediately opens another position to get it back. By lunchtime, he is down 4%. By mid-afternoon, he has entered 5 impulsive trades, each justified by a fleeting rationale that evaporates the moment it is scrutinized. He is exhausted, mentally and financially. When the market closes, he stares at the results in disbelief. The market did not beat him. His neurochemistry did. His brain's natural reaction to loss, the spike in cortisol, forced him into action. His excitement over small gains, the dopamine rush, did the same. Both chemicals created an illusion of urgency that overrode reason, and he paid the price. Daniel's experience is not rare. It is a universal pattern among traders who mistake physiological reactions for actionable insight. The professional approach is radically different. Where the amateur surrenders to emotion, the professional interrupts the feedback loop with precision. The first step is recognition, noticing when a trade triggers intense emotion. Once the surge is identified, the professional invokes the 90-second pause, literally timing it or counting it mentally. During this interval, the trader steps away from charts, breathes, and observes the body's reaction without action. This is not procrastination. It is a calculated buffer designed to allow chemicals to dissipate and clarity to return. Only after this brief but crucial period does the trader reassess the market, reevaluate the setup, and decide whether the trade still meets rational criteria. Often, the impulse vanishes during the pause. The trade that felt urgent suddenly appears unnecessary. If it still meets the rules, the trade is executed with full awareness and risk control. If it does not, it is logged and ignored. Every impulsive decision avoided is a micro victory that compounds into long-term survival and profitability. To understand why this works, it helps to consider the chemical timing. Cortisol and adrenaline spike immediately in response to perceived threat or loss. Dopamine peaks in response to reward anticipation. Both create the compelling sensation that the market will escape your grasp unless you act. Within 90 seconds, these chemicals naturally start to decline, giving the prefrontal cortex, the rational decision-making center, a chance to regain control. Without this pause, decisions are hijacked by the limbic system, and each trade becomes a roll of the dice rather than a calculated move. Professionals build this pause into their identity. It becomes automatic. They train themselves to recognize the moment their biology wants to override their strategy, and they treat the pause as a non-negotiable rule. The amateur sees hesitation as risk. The professional sees it as an investment in accuracy and preservation. Consider another scenario. A trader sees a high probability setup form in the first 15 minutes of trading. The breakout looks perfect. Her instincts scream to enter immediately. She feels excitement, tension, and a familiar itch in her chest. Instead of succumbing, she counts 90 seconds. During this interval, she reviews volume, checks for confirmation, and asks herself, am I reacting to the chart or my adrenaline? The initial emotional surge dissipates. She notices subtle flaws in the setup that were invisible under the rush of dopamine. When she finally acts, it is a measured, deliberate trade with clear stop loss and position sizing. Without the pause, she would have entered impulsively, risking capital on a less favorable entry. The 90-second rule transforms these moments from potential disaster into controlled opportunity. Impulse is the tax amateurs pay for speed. Every premature click is a debit against the account that compounds invisibly over time. While it may feel inconsequential on a per-trade basis, repeated reactions to emotional highs and lows produce measurable erosion in equity. Professionals understand that the market is never in a hurry. There is no prize for the first to react. There is, however, a massive advantage for the one who waits, observes, and allows emotion to settle before making a decision. The 90-second rule is a tactical manifestation of this principle, converting biological inevitability into a competitive edge. It is not a suggestion or a tip. It is a structural discipline that turns instinct into data rather than error. What separates amateurs from professionals is not the frequency of correct predictions, but the consistency of process. When traders implement the 90-second pause habitually, they create a feedback loop that reinforces patience, clarity, and risk control. Each avoided impulsive trade reduces the opportunity for error, conserves capital, and protects the account from compounding losses. Over time, this transforms the trading mindset. The individual begins to internalize discipline, recognizing that the most profitable trade is often the one not taken. Emotional volatility diminishes because the pause becomes a conditioned response. Overtrading ceases to be an accidental byproduct of stress or excitement. It becomes a controllable variable in the professional system. This rule also has a subtle psychological advantage. By deliberately waiting, traders train themselves to tolerate discomfort, the itch to act, the internal pressure, the sense of urgency. These sensations are recognized but no longer obeyed. Emotional resilience strengthens. The trader gains confidence not through prediction but through demonstrated self-control. This internal margin of safety allows for higher quality entries and a clearer evaluation of risk-reward ratios. While amateurs react to price movement, professionals react to rules and reality. The chemical storm that once dictated action becomes a signal, a warning rather than a command. Each 90-second pause is a small victory over biology, a micro-assertion of control that compounds invisibly across weeks and months of trading. Even in high-pressure situations, unexpected market news, sudden volatility, or rapid losses, the 90-second rule functions as a stabilizer. While the amateur panics and doubles down, the professional observes, breathes, and lets the initial emotional surge dissipate. This simple practice turns potentially catastrophic decisions into measured responses. The beauty of the rule is in its simplicity. It does not require advanced technology, complicated indicators, or constant monitoring. It requires awareness, commitment, and a timer, internal or external. Repeated practice converts the pause into instinct. Over time, the 90-second rule becomes a foundational habit, a core element of trading identity that differentiates the reactive from the deliberate, the impulsive from the disciplined. To apply the rule immediately, start by monitoring your physiological responses to market triggers. Note when your chest tightens, your palms sweat, or your thoughts race. These are signs that chemicals are influencing your decision-making. At this moment, begin counting 90 seconds before taking any action. Use this interval to assess risk, verify the setup, and check position size. Ask yourself if the trade satisfies the criteria you would apply in a calm state. If yes, proceed deliberately. If no, record it and move on. The market is indifferent. Your clarity is not. Every pause is a shield against emotional hijack. Every delay a step toward professional level consistency. The 90-second pause is deceptively powerful because it addresses the root cause of overtrading neurochemical urgency rather than superficial symptoms. By the time the interval concludes, the initial impulse has faded and rational analysis returns. Amateurs see hesitation as indecision. Professionals recognize it as strategic discipline. Every decision made after this pause is informed rather than coerced by emotion. Over weeks and months, this habit builds a margin of safety that far exceeds the benefit of any single impulsive gain. Losses are limited, risk is managed, and opportunities are filtered through clarity rather than chaos. The 90-second rule is not a temporary fix. It is a structural solution to the recurring problem of chemical hijack in trading. By now, the principle should be clear. Every emotional surge triggered by the market is temporary, and every impulsive response to it is costly. Professionals convert the fleeting power of emotion into structured evaluation by waiting 90 seconds. Amateurs surrender to the illusion of urgency, believing that action is synonymous with advantage. The reality is the opposite. Restraint creates leverage, clarity, and survivability. Each pause reinforces identity, strengthens process, and ensures that the next trade is deliberate, disciplined, and aligned with strategy. Overtrading ceases to be an accident when it becomes a habit of avoidance of impulsivity, a premeditated method of letting emotions settle before acting. In the next chapter, we will take this principle further. The 90-second pause is not just defensive, it can become offensive, a repeatable edge that compounds quietly every day. We will explore how deliberate waiting transforms into strategic advantage, turning hesitation into opportunity and process into our profit. You will learn how to use this pause to filter setups, sharpen judgment, and create a system where patience, not luck, determines results. The chemical storm that destroys amateurs can, with discipline, be harnessed to build professional consistency, resilience, and edge. Most traders believe patience in the market means missed opportunity. They imagine that every second spent waiting is money left on the table, that hesitation equals failure, and that action must be constant to be profitable. This is one of the most persistent illusions in trading. In reality, waiting is not just safe, it is profitable. Waiting creates opportunity by filtering out noise before it has a chance to cost you. Price movements, sudden spikes, or apparent breakouts may seem urgent in real time, but often these are traps disguised as opportunity. The amateur jumps early, reacting to signals without verification, while the professional uses those moments to recalibrate, to see the tape clearly, and to act only when conditions confirm a rational setup. The 90-second rule is the tactical implementation of this principle, converting patience from an abstract virtue into a measurable edge. It is counterintuitive, yes, but it is also the most consistent form of leverage available to a trader without increasing risk. Jesse Livermore called it sitting tight. He didn't view waiting as a passive state. He viewed it as active observation. He would watch the tape without reacting, letting the market reveal its hand over time. He knew that the pivotal point wasn't simply a price level, it was confirmation through inaction. While others were rushing into positions, compelled by emotion, Livermore was absorbing information, observing patterns, and allowing opportunity to clarify itself. The moment of clarity rarely came in the first instant. It came after the market had tested the emotional reactions of the majority. Professionals are aware of this dynamic. They know that every impulsive trader who reacts early is effectively providing free information. By counting down the 90 seconds, by sitting in disciplined observation, the professional extracts insight while the amateur suffers from the consequences of impatience. This is why, paradoxically, waiting often results in higher quality trades, lower risk exposure, and more consistent performance. To make waiting active, the first step is recognizing the impulse to act and deliberately starting a 90-second timer. This is the same pause we discussed in previous chapters, but here the focus is on transformation from defensive waiting to offensive positioning. During this interval, the trader should engage in a structured checklist rather than idle hesitation. Step 2 is reviewing risk parameters and stop-loss levels before looking at the chart again. By doing so, the trade is evaluated against a predetermined framework, not the emotional tug of price movement. Step 3 involves self-inquiry. Am I entering this trade because the setup is valid or because I am soothing discomfort, boredom, or fear? Often, the honest answer reveals that the initial urgency was entirely emotional. Only if logic survives the silence and the setup aligns with strategy should action be taken. Step 4 is execution, but done deliberately, with full awareness of size, risk, and confirmation. The entire process transforms a simple pause into a tactical mechanism for enhancing probability and discipline. The power of waiting is amplified by its psychological effects. Each instance of deliberate delay strengthens the trader's capacity for controlled decision-making. While amateurs equate hesitation with lost opportunity, professionals understand that every impulsive reaction carries an invisible cost, reducing clarity and compounding risk. By ritualizing the 90-second pause, the trader builds a mental margin that buffers against emotional hijacks. Over time, this margin becomes second nature. The urge to click immediately loses its grip. Emotional impulses are acknowledged, but no longer dictate action. The trader moves from reactive behavior to deliberate execution, and the quality of trades improves dramatically. Waiting is not passive, it is precision under pressure, the subtle yet powerful mechanism that transforms risk management into opportunity maximization. Consider a practical example. A trader identifies a breakout in a high-volume tech stock early in the session. The breakout looks strong. Adrenaline spikes, and instinct screams to enter immediately. Instead of acting, the trader starts the 90-second pause. During the interval, risk parameters are checked, stop-loss levels are verified, and the setup is analyzed against multiple criteria. Emotional triggers are noted but ignored. At the end of 90 seconds, subtle weaknesses in the breakout become apparent. Volume is thin relative to prior spikes, and a nearby resistance level may reverse. Momentum. The trade is either adjusted or discarded. This is active waiting. It transforms impulsive desire into informed decision-making. The market's noise has been filtered, and only legitimate opportunity remains. Over time, repeated practice of this method compounds into a measurable edge. Another advantage of waiting is its effect on self-awareness. Traders who act impulsively often confuse short-term wins with skill, leading to overconfidence and repeated mistakes. By contrast, those who pause and evaluate cultivate a habit of reflection. Each 90-second interval becomes an audit of intent. Why do I want this trade? Am I motivated by logic or by the fleeting rush of emotion? The act of questioning itself is valuable. It reinforces discipline, strengthens decision-making, and allows mistakes to be caught before capital is risked. Livermore's edge was built on precisely this mechanism. He observed, waited, and entered trades only when the market confirmed his hypothesis. The tape revealed truth through inaction, not through impulsive participation. Professionals internalize this principle. Waiting is a filter, a lens through which only high-probability trades survive. The mechanics of active waiting also extend to position sizing and risk control. During the 90-second pause, the trader considers the relationship between position size, stop-loss distance, and account exposure. Impulsive traders often ignore these fundamentals in the heat of emotion. By delaying entry, professionals ensure that every trade aligns with risk management rules. This alignment reduces variance, protects capital, and allows compound gains to accumulate steadily. The pause becomes a tool not just for avoiding mistakes, but for optimizing opportunity. It integrates psychological discipline, strategic evaluation, and quantitative risk management into a single, repeatable process. Over time, this transforms trading from a series of random outcomes into a structured practice of probability and precision. The maxim, waiting is a position, encapsulates this philosophy. It reframes action not as a reflex, but as a calculated decision, informed by clarity and context. Waiting is an active, deliberate strategy that increases the likelihood of success while reducing unnecessary exposure to risk. Every second spent in structured observation is an investment in judgment. The market does not reward haste. It rewards informed, controlled action. Professionals understand this, and they design their routines around it. The 90-second pause, repeated consistently, becomes a micro-habit of control, a measurable advantage that compounds invisibly over time. Psychologically, waiting also reduces regret. Impulsive trades, even if profitable, carry a hidden cost. The trader learns to trust emotion over logic. Over time, this erodes confidence, inflates risk, and increases the likelihood of repeated mistakes. By contrast, delayed, deliberate execution builds trust in one's process. Each trade taken after active waiting reinforces the belief that success derives from disciplined methodology, not from fleeting luck or adrenaline-driven intuition. This alignment of psychology and process creates a feedback loop that strengthens both confidence and performance. Over months and years, this habit separates consistently profitable traders from the majority who oscillate between impulsive wins and avoidable losses. Waiting also allows for market verification. Impulsive traders act on incomplete information. Professionals use the pause to allow price action, volume, and other indicators to confirm the setup. By doing so, the trader effectively increases the probability of success without taking additional risk. The 90-second window may seem short, but in trading terms, it is often the difference between entering a setup with incomplete information and entering one with confirmed, high probability characteristics. Livermore emphasized this principle repeatedly. The market often resolves ambiguity for you if you are willing to wait. By resisting the urge to act, traders gain the clarity needed to make informed, precise decisions. Repeatedly applying active waiting compounds discipline in subtle but measurable ways. Each resisted impulse reinforces the prefrontal cortex's control over emotional reactions. Each deliberate decision strengthens the habit of rule-based execution. Over time, traders find that patience is no longer a struggle, it is a default mode. Emotional storms that once prompted impulsive action are now mere signals, noticed and analyzed rather than obeyed. Trading becomes less about reacting to the market and more about executing a strategy with precision. Waiting, in this sense, transforms from a defensive tactic into an offensive edge. It filters out low-quality opportunities while amplifying the effectiveness of high-probability setups. In practice, traders can implement this immediately. Whenever a trade setup appears, start your 90-second timer. During the pause, review risk, stop loss, and position size. Ask whether the trade satisfies your criteria or if it is an emotional reaction. Observe the market without acting. Only execute if logic survives the silence. This transforms a simple pause into a repeatable edge, turning hesitation into opportunity and reinforcing discipline over time. The 90-second rule converts passive waiting into an active, measurable advantage. The professional mindset treats every pause as a tool for clarity and precision. Each resisted impulse reduces risk, preserves capital, and enhances judgment. Waiting is not a luxury or a psychological crutch. It is a tactical necessity. Amateurs act on instinct and emotion. Professionals act on observation and verification. Over months of consistent practice, active waiting compounds into an edge that is invisible in single trades but evident in long-term results. It is the difference between surviving market volatility and being consumed by it. In the next chapter, we will see how the discipline created by this pause compounds across every trading session. We will examine how repeated application of the 90-second rule transforms hesitation into a strategic asset, filtering out impulsive trades and creating a measurable advantage that accrues quietly over time. Waiting becomes not just a defensive tactic, but a mechanism for building cumulative profitability, mental clarity, and professional consistency. Every avoided bad trade is an invisible gain. While most traders obsess over profit per trade, professionals obsess over damage prevented per week. This is a subtle but profound distinction. The amateur focuses on potential gains, chasing each candle and reacting to every setup. The professional tracks the cost of impatience, measuring how much capital is preserved by avoiding impulsive trades. The difference is enormous. When you consistently avoid trades that do not meet your criteria, the money you keep compounds quietly in the background, building equity without the fanfare of individual wins. Profit is not just made by entering positions at the right time. It is preserved by sitting through setups that tempt but do not justify entry. This is the hidden architecture of sustainable trading, and it is invisible to anyone looking only at gross gains. It is measurable only by disciplined journaling, self-awareness, and a willingness to accept that doing nothing can sometimes be the most profitable action of all. Consider a portfolio manager I once interviewed. He was managing a medium-sized fund with a focus on equities and derivatives. He told me, "My best trades are the ones I didn't take." At first, I thought he was exaggerating, but as he explained, he had a simple rule. Any trade that triggered urgency, any impulse sparked by excitement, fear, or FOMO, was delayed 90 seconds. During that interval, he assessed whether the setup met all of his predetermined criteria. Over a year, he tracked every trade idea that was paused. The data was compelling. 70% of the trades that seemed urgent and were delayed would have lost money. By refusing to act on impulse, he preserved capital that would have been unnecessarily risked. Over time, the cumulative effect of this restraint was enormous. He wasn't just avoiding losses, he was creating invisible gains that compounded into meaningful performance improvements. This example highlights a crucial mindset shift. The professional profits not only from correct trades, but from the judicious avoidance of incorrect ones. Implementing this principle in practice requires structured discipline. Start by tracking every paused trade in a journal. This is not a casual exercise. It is a deliberate act of accountability. Record every setup that triggered a desire to act immediately. Note the emotions experienced: fear, boredom, FOMO, or overconfidence, and document the outcome after the 90-second pause. Over time, this journal becomes a mirror, revealing consistent patterns of emotional reactivity and opportunity costs avoided. On a weekly basis, review the journal to quantify saved losses. Calculate how much capital would have been risked impulsively and compare it to the actual preserved equity. Within a month, traders will notice a measurable rise in net equity, not from better entries, but from fewer mistakes. This is the compounding effect of restraint. Every pause, every avoided trade, and every disciplined decision accumulates quietly, building both financial and psychological capital. The power of this approach lies in its combination of behavioral awareness and quantifiable feedback. Most traders underestimate the hidden cost of impulsive action. A single bad trade might feel small, but repeated across weeks or months, the losses compound. Conversely, every trade avoided adds incremental value by reducing volatility, preserving capital, and protecting mental clarity. This is why the 90-second rule is not just a tactical pause. It is a foundational element of long-term profitability. By creating a structured method for delaying action, traders convert what is typically seen as passive waiting into an active form of risk management. The pause becomes a filter that screens out trades motivated by emotion rather than strategy. Over time, this habit produces a measurable edge, quietly enhancing net returns and reinforcing professional behavior. Restraint also changes how traders perceive opportunity. Amateurs often fear that hesitation will cause them to miss the big move, and this fear drives impulsivity. Professionals, however, recognize that the market presents thousands of setups, but only a fraction meet strict criteria. They understand that missing a trade is rarely costly if it preserves discipline for the next high-probability opportunity. The more consistent the pause, the more reliable the process becomes. This creates a compounding psychological effect. Each avoided impulsive trade reinforces confidence in one's method, reduces stress, and sharpens judgment for future decisions. The professional mindset is not motivated by every apparent opportunity. It is motivated by certainty, probability, and disciplined process. Let's examine a scenario. A trader sees a potential breakout in a major currency pair. The initial move looks promising. Adrenaline rises. Impulse screams to click buy immediately. Instead, the trader applies the 90-second pause, and records the event in a journal. During the interval, they assess risk, confirm alignment with strategy, and evaluate whether the trade addresses a genuine market inefficiency or merely satisfies emotional discomfort. By the end of 90 seconds, the trade may appear less compelling, perhaps volume is insufficient, or support levels are not confirmed. The trade is either adjusted or ignored. The act of waiting has filtered the setup, preserved capital, and prevented an impulsive loss. The invisible gain is not seen on the chart. It is recorded in the account's stability, in the trader's confidence, and in the reliability of process. This compounding effect extends beyond individual trades to long-term account growth. When a trader consistently avoids impulsive setups, the account is shielded from repeated small losses that can erode gains over time. Each paused trade strengthens the trader's mental framework, reinforcing the principle that process matters more than momentary results. Over months, the accumulation of avoided mistakes translates into measurable improvements in net equity. By tracking and reviewing paused trades, traders gain insight into their emotional patterns and develop self-awareness that is invaluable. They begin to see triggers for fear, greed, and impatience, and they learn to manage these triggers proactively rather than reactively. The disciplined use of the 90-second pause becomes both a behavioral anchor and a performance amplifier. It is also worth noting that restraint compounds in a psychological sense. Every instance of delayed action reinforces patience and mental clarity. The trader learns to tolerate discomfort without reacting, to observe market movements without being compelled to participate, and to evaluate setups objectively. This repeated practice strengthens the prefrontal cortex's ability to regulate impulsive responses, creating a neurological advantage that persists even under stress. Amateurs act out of emotional urgency. Professionals act out of deliberate strategy. Each moment of waiting, when executed with discipline, becomes an opportunity to solidify this distinction. Over time, it transforms trading from a reactive exercise into a deliberate, systematic practice. Documenting paused trades is essential because it provides concrete feedback. Traders can see patterns emerge, certain times of day, specific instruments, or particular setups consistently trigger emotional impulses. Awareness alone is insufficient. It must be coupled with action. By journaling, reviewing, and analyzing these moments, traders develop a map of their own vulnerabilities. The result is measurable improvement as patterns are corrected, processes refined, and the likelihood of future mistakes reduced. This disciplined approach converts the abstract concept of restraint into a repeatable, quantifiable advantage. The maxim, profit is what's left after you stop paying for impatience, captures the essence of this approach. Most traders focus obsessively on potential gains, ignoring the hidden cost of impulsivity. Professionals understand that controlling emotion, avoiding unnecessary trades, and allowing process to dictate action produces far more durable results than chasing immediate wins. Every trade avoided is an invisible gain that compounds quietly. Every measured decision reinforces identity, strengthens process, and builds the mental margin required to operate consistently under market pressure. By the end of this practice cycle, traders recognize that the value of restraint far exceeds the value of impulsive execution. The cumulative effect of disciplined pause is evident not only in account performance but also in identity transformation. As traders internalize the process of waiting and filtering emotion, they shift from reactive participants to deliberate operators. This is where the final layer emerges. What happens when restraint becomes part of identity? The trader no longer asks, "Should I act?" The answer is embedded in habit and principle. Impulse is no longer an adversary. It is a signal to execute the 90-second pause. Through repetition, This identity shift transforms behavior from occasional discipline into consistent professionalism. The market becomes less chaotic not because conditions have changed, but because the trader's responses have evolved. Over time, this transformation compounds, both financially and psychologically. The trader who masters restraint builds an account protected from impulsive mistakes. They also build confidence in their process, mental clarity, and emotional resilience. Each avoided bad trade reinforces the principle that long-term success is a function of consistency, not immediacy. The professional mindset is anchored in the quiet power of measured observation, where restraint is a deliberate weapon rather than a passive limitation. Every paused trade, every moment of controlled patience contributes to the larger advantage of sustained performance, reduced risk, and enhanced decision-making quality. By documenting moments of hesitation, analyzing patterns, and quantifying invisible gains, traders gain insight into both their behavior and their results. The 90-second pause evolves from a tactical tool into a measurement system. It provides a feedback loop that highlights weaknesses, validates strengths, and allows continuous refinement. The compounded effect of restraint becomes visible in equity growth, emotional stability, and the ability to maintain composure under stress. By the end of this practice, the trader no longer measures skill by the number of trades taken, but by the number of mistakes avoided. This is the essence of professional trading, disciplined avoidance, not compulsive action. The next chapter will reveal the final transformation. What occurs inside a trader's identity once restraint becomes habitual. This is where the true shift from amateur to professional begins, and where waiting, patience, and discipline evolve into an internalized mindset. The 90-second pause, initially a tactical rule, becomes an integral part of trading identity, creating a foundation for long-term, sustainable success. It is in this final layer that the power of compounding restraint is fully realized, bridging the gap between process mastery and psychological mastery. Most amateurs seek certainty in charts, indicators, and patterns, believing that predicting price movement will grant them control over the market. They analyze, they measure, they click, hoping that observation alone can generate an edge. Professionals, however, seek certainty elsewhere within themselves. They understand that the market is inherently uncertain, chaotic, and often cruel. True edge does not come from predicting every move. It comes from managing one's own nervous system, from cultivating composure under pressure, and from transforming emotional impulses into deliberate decisions. This is the final stage of mastering the 90-second rule. When it becomes internalized, the pause is no longer just a tactical tool. It becomes the foundation of identity. Your nervous system, trained to withstand the chemical surges of fear and greed, becomes your primary trading system. You no longer chase movement. You observe it. You no longer need to assert control. You own composure. Consider the difference in real terms. The amateur reacts to every tick on the chart, feels compelled to click when price moves, and suffers from constant micro-losses caused by impatience. Their account balance fluctuates not only from market volatility but from emotional volatility. The professional, by contrast, acts only when the setup aligns with strategy, when logic outweighs instinct, and when emotion has subsided. Over time, the professional's account is steadier not because the market has become predictable, but because emotional chaos no longer dictates behavior. The 90-second rule, repeated, internalized, and respected, becomes a filter, a shield, and eventually a habit so ingrained that impulsive action feels unnatural. The trader who has mastered this process gains a form of quiet authority over their own decision-making. Jesse Livermore captured this essence when he was asked how he knew the right time to enter a trade. He replied simply, "When I can watch the market without wanting to." This statement encapsulates mastery, the ability to observe without compulsion, to be present without surrendering to emotion. At this level, trading becomes a study of probability, discipline, and self-control, rather than a frantic pursuit of profit. Emotion no longer dictates behavior, it informs strategy. The 90-second rule, when fully internalized, transforms from a tactical pause into a mental operating system. It is no longer about surviving impulses, it is about choosing deliberately under pressure, turning hesitation into authority. To make this transformation operational, every trade is now a test of identity rather than just a test of market conditions. Can you wait 90 seconds when your instincts scream to act? Can you let the market move without needing to intervene, even when your account sits idle or appears to be missing an opportunity? If you can answer yes consistently, you have crossed the line from reactive to deliberate. The 90-second rule is no longer a rule, it is a reflex, a principle embedded in your cognitive and physiological wiring. Every trade becomes an opportunity to reinforce professional identity, to validate patience under pressure, and to align action with process rather than emotion. It is a quiet but profound shift that separates those who survive and thrive from those who are perpetually at the mercy of their own impulses. The mechanism behind this transformation is both physiological and psychological. As traders repeatedly pause and observe, the limbic system, the part of the brain that triggers fight or flight and reward responses, loses its dominant influence. The prefrontal cortex, responsible for rational thinking, probability assessment, and executive function, gradually assumes control. Emotional surges that once demanded action now become signals rather than commands. Impulse is recognized, acknowledged, and allowed to dissipate before decision-making occurs. This neurological shift underpins the professional's edge. It is why veterans can watch volatile markets with calm curiosity, entering only when clarity emerges, while novices are swept away by adrenaline, fear, and greed. This transformation also compounds psychologically. Each successfully delayed trade reinforces confidence in the system and in oneself. The trader begins to trust the process more than the immediate impulse, and over time, this trust creates a mental margin of safety that is far more valuable than any single trade gain. Emotional volatility diminishes, stress levels drop, and decision-making becomes more deliberate and consistent. Whereas amateurs experience whiplash from reacting to every movement, professionals experience steadiness, clarity, and control. They no longer fear the market's randomness because their responses are anchored in discipline, not reaction. The 90-second pause, once a conscious effort, becomes instinctive. Waiting becomes an active position rather than a passive act, and the trader's own composure becomes a tangible edge. Consider a day in the life of a trader who has mastered this principle. The market gaps open with high volatility, news hits unpredictably, and prices swing wildly. An amateur panics, chases moves, and exits early at a loss. The professional watches, evaluates setups against strict criteria, and waits. A potential opportunity appears. The nervous system signals desire. The trader starts the 90-second pause, checks risk parameters, evaluates probability, and questions intent. 90 seconds later, clarity emerges. The trade is entered deliberately, with full awareness, proper sizing, and controlled risk. The difference between these traders is not the market or the signal. It is the state of mind from which action originates. This is the edge that is invisible to outsiders but decisive over months and years. The maxim, "the professional's edge isn't prediction, it's patience under pressure," summarizes this transformation perfectly. Prediction is unreliable. Charts do not guarantee outcomes. The market will always provide uncertainty. But a trader who can maintain composure in the face of uncertainty gains something far more valuable: the ability to act deliberately, to control exposure, and to protect capital under conditions that would destroy an amateur. Mastery is measured not by perfect entry points, but by consistent adherence to process, by the capacity to let emotion dissipate before acting, and by the steady accumulation of advantage through disciplined restraint. This principle closes the loop on the journey we began with the 90-second pause. What started as a tactical rule to prevent impulsive losses now becomes a system of identity. The trader is no longer reacting to charts, candles, or ticks. They are operating from a state of internalized discipline, a calm readiness that is independent of market chaos. Every trade, every decision is filtered through this lens. Emotional reactivity fades. Confidence, clarity, and consistent execution take its place. The 90-second rule is no longer just a tool, it is a lifestyle, a cognitive framework, and a physiological habit that aligns perception, judgment, and action. Even in moments of high pressure, sharp losses, unexpected volatility, or rapid market reversals, the professional's edge remains intact. The trained nervous system prevents emotional hijack, allowing reason to guide decision-making. Every trade becomes a reflection of process mastery rather than fear or greed. By internalizing the 90-second pause, the trader shifts from survival mode to ownership of their mental state, making decisions from a place of deliberate control rather than reaction. The market may remain unpredictable, but the professional is steady. While amateurs panic and overtrade, the professional waits, observes, and executes only when criteria and clarity align. The practical application is deceptively simple but profoundly transformative. Cut losses fast, size positions small. Wait, own your process. Every trade should be filtered through these principles. Execution becomes a function of adherence to process, not impulse. Discipline under uncertainty becomes the true source of profit. Markets do not reward the first to act, they reward the last to lose composure. By mastering this principle, a trader creates both a financial edge and an internal equilibrium that sustains long-term performance. The 90-second pause, initially a rule to prevent impulsive trading, has evolved into a foundation for identity, confidence, and professional behavior. Finally, mastering the 90-second rule is a gateway to further refinement. Once composure is internalized, the trader can expand principles into more advanced techniques, such as pyramiding positions without losing sanity, scaling size strategically, and maintaining discipline as account growth introduces new psychological stressors. The key is that mastery begins with the pause, the discipline, and the internalization of patience. Once these foundations are secure, every other aspect of professional trading, risk management, position sizing, and strategic execution builds on this stability. The professional's edge is no longer dependent on prediction. It is embedded in consistency, process, and composure. The journey from impulsive amateur to reflective professional is complete when the 90-second pause ceases to be a conscious effort and becomes instinct. Traders who achieve this state watch the market without compulsion, act with deliberate intention, and allow emotion to inform rather than dictate behavior. The nervous system, trained through repeated practice, becomes a reliable tool for decision-making, and the trader operates from a state of calm mastery. Livermore's wisdom echoes in this transformation. Patience pays more than precision. The market cannot be predicted, but it can be navigated successfully by controlling oneself. This is the ultimate lesson of the 90-second rule. The trader who can wait controls both the market's chaos and their own mind.